Hello and welcome to another weekly review. My name is Grant Collins. I'm an independent economist with AIM Research. And today we have a lot of data to cover, a lot of good, a lot of bad. So whether you're a bull or a bear, I think you will appreciate it in the marketplace. What came out this week? We had things like personal income. We had a GDP revision. We had another inflation report, as well as durable goods and consumption and new home sales. So lots to cover today. Hopefully we can stick and stay within our same 30-minute time frame, so that way we don't get too lengthy or too long for you here. Let's kick it off. Let's get started with some home data. So let me share my screen here and just show you a little bit about what we were seeing. So not only did you get new home sales, but you also got pending home sales as well. Pending home sales were still somewhat negative, down 20.3% year over year. Compared that to the prior month at minus 23.2% year over year. So slightly better on pending home sales. New home sales on the month hardly moved at all. So it was 683 million on the prior month. That's exactly what it came in at this month as well. The median home sale price still at roughly just a touch over 400,000 at 400 and call it 21,000. However, we did see inventories and the month supply of homes come down. Inventories are now at 433 and the month supply is now at 7.6 months supply. If you couple that with what we've been seeing out of the NBA mortgage applications, those have been declining for 3 weeks in a row. So it's likely that housing still remains somewhat challenged here. It was, again, interesting to see the pending home sales remain negative as well. That probably squares well with the consumer sentiment report from the University of Michigan. It's still below 60 and still remains somewhat slumped as well. So new home sales were, in my opinion, although they moved somewhat sideways here, you can see a little bit of a rebound. Let me see if I can grab a pin here. You can definitely see some turning happening here as the home prices have come down and as the month supply of homes come down as well and the inventory comes down. So maybe there is a flood of buying here as people were trying to get in before interest rates went any higher. We're going to talk about interest rates in a little while because we have seen the interest rates move. Maybe it's a good time to go ahead and jump into them. You now have a heavily inverted yield curve. In fact, if you look at the 10-year minus the 2-year, you're at minus 0.67. That is deeply, deeply negative, very much looking like a recessionary signal. My take, as the yield curve has been negative for a while, is that it was the market's interpretation that inflation was going to come down quicker than the Fed thought that, which is why maybe you haven't seen that recessionary signal yet. There is a pretty long lead time between when it inverts and when you officially get that recession. But I think the other indication is just how quickly the short end of the curve has moved higher here. We now have some additional speculation in the 1 month market. I mean, the 1 month now is trading at almost 6%. I don't think the Fed funds rate is going to get to 6. I've been talking about this for a while, but there's plenty of evidence that the Fed's restrictive. Whether you see the senior loan officer survey data showing some tightening going on, whether you see the yield spreads between like the 3 month and the 1 month, or the 3 month commercial paper and the Fed funds, those spreads are still elevated and show some stresses in the system. And then, of course, you have just the banking system, right? If they were not restrictive, there would not be bank failures. And I think that's another sign that the policy is above the restrictive level in the economy. But because of the debt ceiling conversation, you do have a situation where the 1 month has been gyrating back and forth. If you remember, the 1 month traded extremely low as everybody kind of piled in and they were worried about recession during the banking crisis. And now that 1 month has shot back up as they don't want to hold the 1 month because they are afraid they may not get paid. So there is, again, some dislocations happening in the yield market. The uncertainty around interest rates not only carries from the market, but also carries to the Federal Reserve. So we also got the FOMC minutes this week. They talked at length about the conditions in the economy and in the business cycle. And I would highly recommend you take some time to go read it. Just a couple takeaways from my part. They were uncertain around policy going forward. They wanted to affirm that cuts were off the table. There's a pretty good quote in there where it says participants wanted to make sure that the language that was portrayed in the FOMC meetings and Jerome Powell's convey of monetary policy, that there was room for both future increases as well as holding interest rates restrictive. They really did want to remove cuts off the table, and I think that reflects the market still being dislocated with the 10-year at 3.8, a 2-year at 4.5. If there's no cuts on the table, the 2 years should be closer to 5.25. It probably should be a lot closer to the Fed funds rate right now. And the 10-year should be at least about 1% higher from here. What could be happening here is the market's just reflecting a potential policy mishap or a policy mistake, and they could also be thinking about, a recession that's still yet to come. You're going to see some of the data in here that can confirm and deny it. That's why I said today's data is still somewhat mixed. And so I want to continue to show you some of that here as well. Now, going back to the Fed for just a little bit longer, the other thing that they were uncertain on was they were uncertain on whether or not the senior loan officer survey data, which showed slowing demand in credit creation and tighter lending standards, they were uncertain or unclear around the potential impact to policy because of that. I find that hard to believe. They've got multiple PhD economists up there, and not one person can confirm the impact of tighter credit conditions. I've ran my own estimate on it, and again, for what it's worth, it's somewhere between 0.3 and 0.5% on an increase in interest rates. So it's equivalent to maybe 1 or 2 rate hikes. Again, there's some uncertainty there just because of statistical significance, but still, I expect some further restrictions coming from that tighter lending standards. But when you read the FOMC minutes, there was really no consensus, no clarity on how they viewed this tightening of credit conditions. And I think that's important too when we look at interest rates here. Let's come down a little bit further, and you can see the Fed funds graph, and you can just see how far that 1 month is trading between the two bands, right? So let me just continue to draw these bands out. There's the lower band. Here is the upper band. It looks like it's just getting cut off a little bit. And then here is the current Fed funds rate. You can see it right in here. So with the 1 month trading extremely high and the 2-year trading much, much lower here, you can definitely see the dislocation that's happening in the market. So you've got the 1 month that's playing off of the debt ceiling, and you've got the 2-year playing off of what market participants think are going to happen. Historically, that 1 month trades within the band. So the 1 month being outside both directions tells me that there's some stresses in the system, tells me that you may have some increased volatility a little bit later. And we saw some increasing volatility this week here. What else do I have for you? So that, covers the FOMC minutes, that covers the interest rate decision. I didn't put charts up for this, but we did get 2 more survey data from both Richmond and Kansas City. Kansas City, let me just double check my notes so I don't tell you wrong. Kansas City came in a little bit better. It was minus 21% on the general manufacturing index. The prior month, it came in at minus 2. Richmond came in worse, minus 10 on the prior month versus minus 15 for the current month. That continues to create some dislocations in what we were seeing in New York and Philadelphia in the prior week. New York coming down dramatically while Philadelphia improved quite a bit. What that tells me is that manufacturing is continuing to be in a recession. You can probably see that manufacturing component showing up in like the goods consumption when we get there, or just showing up in durable goods. So maybe let's take a second here and talk about durable goods. Durable goods have been highly erratic from a month-over-month perspective, and it's been erratic primarily because what we've been seeing is the defense spending has had an outside effect from one month to another month. It had another big effect this month. So just real quickly on just the headline number, the durable goods month over month came in at 1.1% compared to 3.2% prior. What led this report specifically was the defense spending in aircrafts and parts, and I'm going to show you that here. But let's just take a look at just the general trend of durable goods. So you can definitely see that the trend is still higher, but you can see this kind of flatlining here of durable goods sales. This, on a cyclical perspective, you can see it a little bit better, is slowing down, but you can see just briefly how the 1 month improved slightly. Let's take a look at the individual categories. You can see it. If you take defense spending out, again, you really get to see that flatlining again, rolling over pretty hard. And if you take out transportations, you can definitely see the flatlining. So without transportation goods, new orders, motor vehicles and parts, things of that nature, without defense spending, durable goods would likely be negative here. Here's again that slowdown on a cyclical perspective when you remove transportation. So individually, let's look at like machinery goods spending, again flat and showing a decline on a cyclical perspective. Primary metals have come down and again have flatlined here, again showing that deceleration. Fabricated metals, the exact same thing, flatlining. Here's one that I think is going to continue to show some improvement, especially now with this artificial intelligence craze. I would imagine there's going to be more spending. I mean, look at what happened during the dot-com era. When the computer came out and everyone started to really, really drive and try to get more productivity out of the computer. We're probably going to see something similar to that. I think Morgan Stanley was one that came out and showed the progression of the computer during the dot-com bubble and said, look, first you have the chips, then you have the devices, and then you finally have this kind of commercialization or use case for individuals and rolling out to consumers at that point. We're at the chip and the conductors are getting better, which means the devices are going to get better, which means the end product to the user is going to get better. And so I would definitely continue to watch the computer cycle here. You can see that it's pretty well flat. And I think that's important to note. Another thing, electrical equipment, appliances, and components. Again, if we continue to have this solar panel electric vehicle craze, this is another component that's going to continue to help. You can see that the trend is directionally higher. It has slowed down a little bit, but that's another bright spot in the durable goods orders here. Transportation, again, we said if you took transportation out, that durable goods is somewhat flat, and that continues to remain the case. It's a strong point in durable goods orders. Here's the motor vehicles, which we did see in the consumption basket, that motor vehicles was a big reason for the increase in consumption here, and you can see that the trend is directionally higher. And again, this trend on a cyclical perspective being somewhat flat, looks really good from that perspective. Here's the defense spending, and again, you can see this outside move here. This from time to time, again, can really make the month over month volatile in durable goods, but defense capital goods, again, you're seeing a pretty large increase here. So again, it looks like when you look at the major components, the machinery, the primary metals, again, coming back up here for a second, fabricated metals, primary metals, all of those show a pretty sharp decline, where when you get into more of the nuance, like your computers, your electrical equipment, transportation, and defense spending, those showed some increases here. So I think on balance, it did signal what we have been seeing from the Fed survey data. The Fed survey data all showed new orders kind of staying roughly the same. We didn't see a huge drop off in new orders. In fact, when you even get the S&P Global Composite, which came out on Monday, it improved a little bit, going from 53.4 to 54.5. However, that was primarily driven by services. But even in that report, they showed that new orders stayed roughly the same. So I think that's what we're seeing. We saw a big drop off in new orders, which is kind of what you're seeing here. And now maybe you're seeing some leveling out here. And that sticks and jives really well with the story that I'm portraying. If I could redraw this for just a second, if you have GDP or growth on the x-axis, and you have the inflation rate on the y-axis, and you have the intersection of your trend or potential rate in the economy with your inflation rate, that's the perfect level of demand in the economy. And it looks like I can't draw it well. But when demand declined due to rising interest rates, due to recessionary fears, what that's done is it's created a gap in the economy that can be somewhat recessionary. That's this gap that you're seeing here between the starting point and the second point here. And what that gap does, that slowdown in demand actually puts downward pressure on inflation. And what you can see is once prices come down enough, you actually get back to your original point here. And so that's my thought is as demand cools off, as prices cool off, that's going to create a resurgence of demand as people were maybe waiting on some projects or waiting to get in because they just thought prices were too high for one reason or another. That's a great segue into the inflation report that we received. So it actually showed, because we're looking at just PCE in particular, it actually showed PCE accelerated slightly. So for instance, the month over month came in at 0.4 versus the prior month at 0.1. The core came in at 0.4 as well versus the headline at 0.3. Those year over year numbers for you, let's come down here and look at those. Here's the headline PCE coming in at 4.28. Again, very much deceleration, but you can see very faintly how it ticked up just slightly there. And then if you remove food and energy, you get 4.7. And again, even though you see a trend lower, you definitely see a small little acceleration here month over month. Why did it accelerate? Well, it's the same thing that happened in the CPI. It's still the services side. Services coming in at 5.53% year over year. Again, it's still a reflection of the housing sector, particularly. I mentioned this before. We have seen other measures of rent inflation coming down, like the Zillow home estimate has come down. And so I expect that to feed through at some point. But when you look at the other two components, food has come down, but still remaining somewhat sticky at 6.9%, and energy coming down 6.3%. You can see energy increasing a little bit. Energy was actually up 0.7% month over month in this report. We saw that OPEC has been trying to cut production. We've seen the Biden administration trying to replenish the strategic reserves. And so the combination of those two things have actually tried to keep a floor under oil prices around $70 a barrel. We'll see if that can actually end up happening here. Food actually declined 0.1% month over month. So that's why you continue to see progress on the food front. This report does complicate it for the Fed. The Fed is already uncertain to what to do with policy, right? They're uncertain around what the impact of this tightening of credit conditions can do. But the fact that now that you have sticky inflation data, that pretty well tells you real quickly there that the progress they've made has been slowing. And so now they have to think, okay, do we increase further? And the odds of that have changed. Everybody has now started to price in 0.25% increase in June. So we'll see if that ultimately comes out. Again, I'm in the camp that they should just be holding and just having really strong language around tightening and remaining restrictive at 5% plus, but continue to run the balance sheet off in the background. I think the balance sheet runoff in the background can be extremely beneficial and extremely helpful, and they need to be using that other tool just like they're using the interest rate tool. Let me see, what else do I have for you here? So that was just some of the things that were kind of good, kind of bad. The other thing that I think was interesting is you got initial jobless claims coming in much lower, coming in at 229,000 versus the prior at 242,000. That was completely out of my expectations. I thought we would now be trending higher in the 240 to the 260 range, and that we would hold there for some period. The fact that it came down, I think, was really interesting, and we have to watch revisions going forward from here. The data might get revised higher over time. But definitely to see that move lower was a surprising sign. Another indicator that says the Fed could potentially move forward here. We also got the GDP revisions, which actually came in a little bit better, came in at 1.3 versus the actual first quarter estimate of 1.1. What actually boosted this a little bit was a revision to the private inventories. And so I saw that, but that was not the headline of this report. The headline was the GDI, which was not released the first time. GDI was released the second time. So I'm going to come down here and show you GDI real quickly. One, two, here we go. So here's GDI versus trend. You can see that GDI on a nominal basis has kind of moved somewhat sideways here. You can definitely see that GDI is also declining just like GDP is. But if we compare GDI to GDP, what everybody has been talking about, and I'm going to zoom in so you can see it, is the difference between the two readings. Historically, if you zoom out, the readings are really tightly correlated. There are periods where you get some dislocation, right? So don't get me wrong there. There are some times where GDI looks a little different than where GDI looks a little different than GDP. But when you look at it from a cycle perspective, you can really see the difference. So if you look here just briefly, GDI is in blue where GDP is in red. These numbers here are the difference between the trend rates. So GDI is $275 billion above trend, where GDP is $690 billion above trend. But look at the sharp decline in GDI versus the decline in GDP. Not very, very different, extremely different when looking at those two. We have seen dislocations like that before. Take this one here before going into COVID, there was a dislocation in GDI versus GDP. Take a situation here before going into the 2000.com. Take one here where it was the complete opposite, where GDI continued to accelerate while GDP came down slightly. That was the primary header for this report, was seeing that sharp difference between GDP and GDI. If you average them together, I don't know that I have that chart. I should have put that chart on here. If you average them together, the year over year was barely positive, a 0.3 year over year. So I do think that was interesting in the GDP revision. So I definitely wanted to share that with you today. That really took a market signal and said, look, if you average GDI and GDP together, there's been no change for 4 of the last 5 quarters in GDP. And that kind of meshes with the fact that, hey, we've stopped the big decline and now we've kind of flatlined. And that could be this reacceleration of demand as prices were to come down. The other good thing that we saw last week here was personal income. So personal income increased month over month. Personal income coming in at 0.4 versus the prior month at 0.3. You're going to look through here. The increase primarily came from assets. So income coming from assets, particularly dividends and interest. We saw a pretty good increase from that, and I'm going to show you that here. The trend from income still looks directionally higher, and you can actually see just briefly how it's hooked higher after falling dramatically here. I still leave transfer payments in here. Some people take them out. I like to leave them in because that is income. And I think by leaving them in, it helps us understand this cycle a little bit better. We know that the government had an outside move on personal income by giving 3 stimulus checks. And so I want to illustrate that here. So you can see that personal income on a nominal basis is 5.4% compared to 4.3, so still well above trend. And you can see that it has kind of bottomed and kind of started to reaccelerate here. Here's the real personal income. So once you do adjust for inflation, it has also improved, but has flatlined here. So it has stalled its increase. So you can see how when you adjust for inflation, you don't have that upward trend anymore. Inflation is kind of holding those down. Here, however, though, if you still adjust for inflation, 1% compared to the trend at minus 0.7. So again, still improvement of personal income here. That's a good sign for the economy. Here's wages and salaries again on the upside here, but when you look at it at a cycle perspective, rolling over, and again, it's below trend at 5.6 compared to 7.2. Here is what's really driving this income report. It's the dividends and the interest. You can see how there's no real change other than some upward movement. So personal income receipts on assets looking extremely strong, up 6.3% compared to the trend of 4%. Disposable income still above trend as well. So that's positive as well for consumption, which we'll look at in just a second. And the personal savings rate still holding at about 4.1%. And that also is trying to come up a little bit here as well. So let's look at the consumption side. Now that we looked at consumption from an inflation perspective, you can definitely see that the trend of consumption is directionally higher. On a cyclical perspective, it is slowing down, but services continue to be the outside contributor here. You can see that that's the largest or the lion's share of consumption. About 66% of consumption is services, with the remainder at goods. If you zoom in here briefly, you can definitely see services versus goods. So services still remaining somewhat resilient, while the goods economy continues to slow down from a consumption perspective. And inside of goods, whether it's durables or whether it's non-durables, both of them are directionally lower here. So services, I think, is the lone ranger. It's the only positive to this economy right now. So if consumers, unfortunately, if they're not feeling confident, if they're not receiving higher pay raises to keep up with this sticky inflation, then we could see the service sector of the economy slow down. There's another strategist that I listen to frequently and appreciate his insights, Dr. Yardeni. He is one that believes that the baby boomers are having an outside move on services, particularly because they are moving into the retirement phase in masses, and there's a large cohort of them there. He currently believes that particularly that they are spending money in food and leisure and hospitality and lodging and traveling. And that's why when you also look at the jobs report, that's why you're seeing an increase demand for those particular skills because the baby boomers are having an outside influence on it. He also goes on to say, look, COVID is a potential reason for this, as they stayed in trying to understand and protect their health. And now that that threat seems to have gone, they've come back out in masses and started to spend again. I don't have any evidence of that other than just anecdotally listening to him and appreciating his comments. And I think that's an important note to have here. My final thing that I want to cover today is, what does that mean for the stock market, right? I'm not going to make any calls on any particular investment here, but just from my viewpoint, because we are seeing some good data, some bad data, my initial call about 6 months ago was that we were going to be in this trading range, and that's exactly where we've been. We've been stuck between this 4,200 and this kind of 3,700, which is where the prior low was back in October. So if we just take a second and maybe just draw two lines here and then maybe another line like right in here, we are officially through that 4,200, but you can definitely see that trading range that I've been talking about. There have been a lot of improvement from that previous low, and it could be because you had the inflation rate rolling over, you had a light at the end of the tunnel of Fed interest rate policy. And where I think you continue to bump in this channel here is two things. One, corporate profits came out negative at minus 6.8% for the quarter. We knew that. We knew that because quarterly earnings that are released from FactSet came down 2.2% in Q1, and they were down, I believe, 4% in Q4. So the fact that you have two negative quarters of earnings did reflect in the corporate earnings release that came out with the GDP report. And that makes it extremely difficult to break above this top band. If company earnings aren't improving, it's hard for the S&P to trade materially higher. It's also, at the same time, it's hard to break materially lower because I think most of the risk in the economy are apparent, right? Whether it's interest rates moving directionally higher from here, whether it's the debt ceiling, whether it's Russia going further in Ukraine, or whether it's tensions with China heating up. I think you do need an additional shock to run through the floor, and this is where this trading range makes a lot of sense. I'm going to show you down here this survey here from the AAII. You could probably see it best when you look at the percent bullish versus the percent bearish. The percent bullish is setting at about 27%. That's an improvement from 22% in the prior week, versus the percent bearish is roughly almost 40% at 0.39. That's come down a little bit. It was actually 0.3978, I believe, and now it's 0.3969. So not a huge change in bearishness, but you can definitely see when you add those two together that there's still quite a bit of people that think there's not going to be a lot of change in the S&P. And so this is where that trend call from me is coming from here. You can use these two to give you an indication of like volatility, for instance, and here's the volatility at roughly 18. It's still extremely low, versus like if you get above 30, you get into some really high volatility situations. Volatility has been coming down, but if we continue to have a debt ceiling concern, if the 1 month continues to gyrate in the short-term funding markets and create pressure on the Fed, then you could see increase in volatility. And you can actually probably see that in the bull-bear ratio, which does track really well with volatility. So if the bull-bear ratio really starts to accelerate, you might see an increase in volatility here as well. Currently, that bull-bear ratio is setting at 0.7 here. As far as individual sectors, it looks like communication, discretionary, and tech are leading the way here, while just about everything else is decidedly negative, especially your defensives like utilities, staples, and healthcare. That's where everybody tends to flow when times are worrisome. It seems like now everybody's focused on growth. If the economy is going to be growing below trend, if there is low prospects for the economy in general, which I believe there are, even the Fed believes that you still need the economy to grow below trend to get this inflation under control, then you're likely going to have a situation where people will pay for growth. And I think that's what you're seeing right now. So I think I got a little long-winded here, but I definitely wanted to pick through all of this data that you're seeing here. Stick with us as we come into next week. We'll try to continue to bring you these updates for you, so that way you can also understand how the economy maybe merges with the market here and try to help you make heads or tails of what seems to be a really difficult economy and market call here. When you look at it, I believe everybody last year was calling for a recession. They're still calling for a recession. We set and provide our forecast for the Philadelphia Fed, and that forecast, as I mentioned in a prior video, still below trend growth at 1.3% compared to the 1.8 trend. However, a lot of them cited increased concerns for risk in the back half of the year in Q3, Q4, and potentially even spilling over into 2024. So I'll continue to provide you these updates. I think one of our listeners called it a nowcast, and I really like that. I really appreciate that. It's kind of trying to be unbiased, just trying to give you the data that's come out. I'll give you my take and what I think is happening here. And again, I think there's enough evidence to show both a good economy and a bad economy. That's why the economy's flatlining, and I think that's why the market's kind of flatlining here too. So with that, I hope everybody has a great weekend. It's a 3-day weekend. Be with your family, be safe, be well, and we'll be back again next week with another update.